What's shakalacking there, YouTube? So today we're going to be talking about what the nuggets are options. So we're going to talk about options here. What are options in general? What are call options? And what are put options? So we're going to be using Ford as an example, and then we're going to go ahead and define what are options. We're going to see what calls are, what puts are, how you make money off each. So it should be pretty interesting. So let's dive in. So here quick, we've hopped on Robinhood. We're going to click Ford. We're going to hit trade at the bottom here, and we're going to look into trade options. So we're going to hop into here, and you're going to go over to the buy or sell area, click on buy. We're going to look at calls initially, and you can see all these option contracts for Ford. So we're going to go ahead and click on this one here, type in 1 here real quick, and you'll see it's in terms of 100. So this one contract for 5 cents a share would cost me $5. Here's the Greeks, which we'd look into on another video. These are a little bit more advanced and a couple other stats on it. And then you can go over to puts if you want to buy a put, and then you can go ahead and click on a put, type in 1 in terms of 100, so then it would be 14. So just a little simple example on Robinhood. All right, guys, so we're going to have to define it. And if you enjoy the content, please like and sub, and let's go. So options defined. So it's kind of boring to have to define it, but we need a base of what we're going to be learning about. So a stock option gives the investor the right, but not the obligation, to buy or sell a stock at an agreed upon price and date. So what does that mean? So you have the right, you could potentially buy, and options premiums are always in terms of 100. So that'll be important, and we'll cover that a little more next here. So option contracts are always in terms of 100. You have the right to buy 100 shares of that stock on that date for that price. So we're going to kind of jump into that in our example here right now. So the first thing we're going to be talking about here are calls. And if you are buying calls, you are bullish on the stock. You're a bull. So if you're buying some calls, you think it's going to rise, the price of this stock. So for an example, Ford stock. Let's say you're buying a call on Ford's stock with the expiration date of July 10th. And generally speaking, they expire on Fridays. So generally speaking, your calls are going to expire on Fridays. So you're buying a July 10th expiration date, $6.50 call for 12 cents per share. Now remember, it's always in terms of 100 for your shares, always in terms of 100. So this is actually going to cost you $12 because you're buying this in terms of 100. So 12 cents times 100 is $12. So that would be the cost of this contract. So always in terms of 100 shares. So on July 10th, you would have the option, but you don't have the right. You have the right, but you don't have to buy 100 shares for $6.50. So you'd have the right, but not the obligation to buy 100 shares for $6.50. So let's throw on the board how you'd make money off that. Okay, so how can you make some money off of this? So let's say it is July 10th right now, and this is the expiration date of your contract. So Ford, if you're making money, Ford is $7. Well, congratulations. You picked a stock, it went up, you're in the money now, it's above your call price, which is good. So you must think though, so our call price was $6.50, and it costed 12 cents per share. So each share costed us $6.62. So you're going to make that difference between the current share price and what your total cost for your call was. So our total cost for our call was $6.62 per share. And this is in terms of 100 here. So theoretically, it's at $7 per share, and it's costed you $6.62 per share. So if you exercised, you'd be buying 100 shares of Ford for $662 if you exercised. But the value of those shares is $700. So what's the difference here? $38. So guys, you just made $38, which is great. That was the difference between the premium you paid and the strike price and what it's currently worth. So you made $38, and this option is now in the money. So this is an in the money option, and this is how you make money off options, guys. So this one would have been in the money, and you would have made $38, which isn't too shabby. You only invested $12 in this option, guys. So you basically 3x'd your money right there. So that's pretty sweet. So you made some money on this one. And you don't need to buy the shares, guys. You don't need the money to buy 100 shares of whatever. you can sell the contract for the current value. So this contract, in terms of 100, would have been worth $38. On the day of expiration, you can now sell this contract for $38. And Robinhood, at least that's the brokerage I use, would just sell it automatically on day of expiration for whatever it's worth. So if you didn't have the money to buy these shares, then you would just sell your contract for the current value. And the current value on day of expiration would have been $38 here. So how do you not make money? So let's say Ford is $6. So why in the blue skies would you buy Ford for $6.50 for 100 shares when it's $6? So if you are anywhere below the strike price, and that's the price that you wrote your contract out for, if you're anywhere below that strike price, you are then out of the money. So it is now worth nothing, and your options contract is worth $0. That's why options can be kind of scary, because they can go to $0 really, really easily. So Ford, at $6, if your strike price was $6.50, that is out of the money. If you're anywhere below $6.50 on expiration date, that's going to be worth $0. And if your price was like, let's say, $6.55, let's say, then you would have only made $5 on the contract. But remember, you spent $12 on the contract, so you've lost $7. So if it's slightly in the money, you can still lose money, because that is the value of the contract at the end there. So that is how you would make and lose money off of calls. Okay, so now that we've got calls, puts should actually be quite easy. It's the opposite. So you have the right but not the obligation to sell, guys, 100 shares at a current price. So now let's use Ford as our example again. Let's say you bought a Ford $6 put. It could be the same expiration date, let's say July 10th again. Doesn't really matter in this example. So same expiration date, July 10th. You bought a $6 put, and you bought this for 10 cents. So you bought this for 10 cents, always in terms of 100. So this ended up costing you $10 for this option. That is your premium you have paid for this option. Let's say July 10th swings around and the share price is $5.50. So now you can sell 100 shares of Ford for $6, and then its current share price is $5.50. So now you've made that difference. So you've made the difference with a put, and now you've made $50. But remember, the initial cost was $10. Your initial cost was $10 of premium for that contract to give you that right to sell the shares. So you've actually made $40. So if you're a big old burr, then puts would be what you want to do, because you think the share price is going to fall. So you would sell your shares for $6 a share. Anything below that, you're going to make the difference. So if it was $4, you'd be selling 100 shares. You would have made 200 smackers, which would be really cool. So if it's anywhere above $6 though, greater than $6. So this would be a put. That would be, again, in that money. So if you were greater than $6, now you're going to be out of the money, because you're going to be selling at $6, and there's no value there if it's higher than $6, just the opposite of calls. So that is how you'd make money and how puts work, just simply the opposite of calls. Okay guys, so that's going to go ahead and wrap up for our simple options examples here. So next week I'm going to be diving into, the Greeks here. So the Greeks are the things that break down how much a option can move, and that is your premium you pay for that option. That is built into the Greeks. So there's volatilities in that. You have delta, which if it swings up or down $1, you can see how much it moves. So we're going to dive into the Greeks and do a better breakdown of the Greeks on options, which are all those little fancy numbers on the bottom. And then eventually I'm going to show you what I like doing, which is called the wheel, which is a pure theta play, which is a time decay play. So instead of buying a call or buying a put, I like to sell calls and I like to sell puts. So we're going to also get into that. So hopefully you enjoyed today's content. Like and sub if you want to see anything I got cooking in the future, and you guys go make some money.